You need to know how the bond market works, or even what it is for that matter. Professor Richard Wolff lays it out. Check it out, leave your comments, ding the bell, share it with your friends, and subscribe to our channel. Back on the line with us, Professor Richard Wolff, the economist, professor of economics, co-founder of democracyatwork.info, author of numerous books. His most recent, The Sickness is the System, When Capitalism Fails to Save Us from Pandemics or Itself. It's also available now as an ebook. Democracyatwork.info and rdwolff with 2fs.com are his websites. You can tweet him at Prof Wolff, PROFWOLFF. And Professor Wolff, welcome back. I'm looking at a graphic that was in the, I believe it was in the New York Times daily newsletter. You know, they have an economics newsletter, although it might have been Axios. My printout doesn't reference it, and I don't recall. But in any case, it points out that back in April, the 30-year Treasury bond yield was 1%. It then through July and October floated up to around 1.5%. And in the last month or so, it's gone, in fact, actually from January 1st to today, it's gone from 1.7% to 2.75%. What the hell does that mean? Are government bonds, does this mean that people should be buying 30-year treasuries because you get a 2% return? I know that if you buy an exchange-traded fund of long-term bonds, as the interest rates go up, the value of the fund goes down and you lose money. Can you please explain to us what the bond market is, how it works, and why the average person what the average person should know about it and why they should care?
Well, the bond market is basically a place where people borrow money. And what you get if you lend someone money is a piece of paper which we call a bond. It's a promise, in effect, to repay you at a certain date and to give you a certain interest while you wait between now when you make the loan and when you collect the repayment. It is used by governments. It is used by corporations. Those are the main players in the bond market, local, state, federal governments, foreign governments, and so on. The rising interest rate is very interesting, and the reason for it, as best most of us can tell, is the expectation of people that there may well be, and that's all it is an expectation, that there may well be an increase in the price level going forward. I mean, we have been pumping up the money supply in this country for many years, unprecedented in the history of the United States, number one. Number two, even though we've had a repressed economy for the last year, the COVID situation, the collapse of our economic system again, the third time in this new century, we've had a period of repressed activity because of those things. That is now maybe, and again I stress maybe, coming to an end if the downturn in cases continues, if the new variants aren't dangerous as expected, if the vaccinations proceed. You could then have an interesting combination of all of that accumulated money and a kind of post-crash, post-COVID euphoria in which an awful lot of people grab portions of that money, run into the market to buy everything from land and buildings to appliances, housing fixtures, and all the rest. And what you see in the bond market is the desire people have to prepare for that kind of an eventuality. And what that means is if they're going to give up money for a year or two or three, they want more interest paid to them than they demanded before because the risk of an inflationary upswing in prices exists. And the Fed Chairman Powell's comments over the last couple of days in which he says he doesn't care if that happens, the Federal Reserve is not going to step in to stop it, well, that makes people nervous in the bond market, and they demand higher interest rates. And I think that's what we're seeing. No one knows whether that will continue. No one knows, even if it does, how long it will continue. But here is something we do know. When interest rates go up, and if the Central Monetary Authority, in this case the Federal Reserve, does not step in to prevent that, which it could, but it says it isn't going to, then we're going to see interest rates across the board rise. And that means larger car payments if you're buying a car on time, which most Americans do, rising mortgage rates, which may have a bit of a depressive effect on the housing market. This is a serious possibility in a way that it didn't seem to be up until recently.
So when interest rates go up, the Republicans are already doomsaying this. They're saying, this increase in the 30-year yield in the federal Treasury market or bond market suggests that inflation is coming. If inflation comes, we're going to have to pay more on the national debt, which is these bonds, right? And if we have to pay more on the national debt, then we can't afford to be borrowing money to stimulate the economy, and so we should cancel, Biden's $1.9 trillion program and quack, quack, quack. It seems to me like the easy remedy to that is, okay, fine, let's not borrow any more money. Let's just raise taxes on rich people. What am I missing here?
You're not missing anything. What you're doing is you're adding. I'm like you on this, Tom. Really, it blows my mind as an economist. It's always the case that if you're looking at the problem of raising the money to pay for what the government does, you have two options. One is to tax, and the other one is to borrow. If you don't want to borrow for good reasons, then you tax. And if you tax, you ask the question, whom should we tax? And there the answer is very clear. You choose between the business community and individuals, corporate tax versus personal tax, and then you organize whichever one you choose to be a tax that's flat or a tax that's progressive. So the answer is we should be having these conversations that include who should pay a tax if we don't want to go into debt. What the Republicans do is what the rich people in this country and the corporations want them to do. Have this conversation as if taxing them was somehow off the table, somehow not part of the conversation. And they're so successful that major parts of mainstream media seem to write their articles or give their announcements as if the choice is between borrowing more or less or cutting the spending. That's never been the choice. That is a misrepresentation because they've left out what they fear, which is a discussion of taxes, which would, of course, lead a rational person to say the people who should pay the most are those who have the most and those who have gained the most in the last 30 years. And that's corporate America and the top 1% of our people. That's why they don't want that in the conversation, but you're not missing it. You're getting it exactly right.
Yeah. So we have got about 45 seconds here. What impact for people who are investing for the future would inflation have? Does that hurt stock markets? It seems like it depresses housing prices, but what other impacts does it have?
It has very, very mixed effect. The immediate effect, and it's hard to predict in the future, and when people talk confidently about where it's going to go, talk to somebody else, because that's stargazing. That's not serious questions. Here's some of the effects very quick. Number one, it hurts the stock market, which is why the stock market's been going down the last few days, because if you can make 2, 3, 4% in the bond market without taking risks in an economy that is very fragile, then you see stocks give way as people move into higher interest bonds. And that's one of the phenomena you have to take account of now. The Republicans don't want to talk about that, but that's a serious issue.
Got it. Professor Richard Wolff, democracywork.info, rdwolff.com. Thank you, sir.
Thank you.